You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. With the 10/15 deadlines officially behind us, it's now time to talk about year-end tax strategies and what moves you can make to optimize your tax position before the clock runs out. We'll be diving into all of that in just 1 minute. Are you ready to prepare for 2025 with strategies that will save you money and optimize your real estate portfolio? Whole CPA and Tax Smart Investors is bringing you the Year-End Tax Impact, a one-day virtual event where it will be equipping you with the tools you need to finish the year strong and dominate the year ahead. At this event, you'll hear from top industry experts on essential topics like how the post-election results will shape your investments and your taxes. You'll also discover wealth-building strategies designed for 2025 and beyond. Plus, you'll learn year-end power moves so you can optimize your taxes before the clock runs out. And for our VIP investors, you'll get exclusive access to a tax strategy panel and even a live Q&A where you get answers to your most pressing questions. If you're an individual investor or small partnership, this event is specifically tailored for you. And the best part, no travel required. You can join us from the comfort of your own home via Zoom. Don't miss out. Reserve your free ticket now by visiting www.taxsmartinvestors.com/year-end-tax-impact and arm yourself with the strategies and insights that could save you money, time, and a whole lot of headaches. With over 500 investors expected to attend, this is your chance to connect, learn, and prepare for a prosperous 2025. Again, just head over to www.taxsmartinvestors.com/year-end-tax-impact to grab your free tickets today. We'll see you there, but for now, we'll dive right into today's episode. All right, and we're back. And again, today we're going to be talking about year-end tax strategies for real estate investors. So we're going to touch on some things for business owners and individuals as well. Ryan, what is your favorite year-end tax strategy?
Probably considering buying another short-term rental before the end of the year. That's a big undertaking, to be honest. But I have several clients right now who are kind of asking, okay, I already invest in short-term rentals, or I want to buy a short-term rental. Is it too late in the year to move forward? And depending on when you're listening to this episode and when it comes out, we're recording this in October. It might not necessarily be too late. I have seen one or a couple clients who have acquired a short-term rental right at the end of the year here. And then they get the, couple stays to keep the average less than 7. They get there at least 100 hours and have more than anyone else for material participation. It's hard. Don't get me wrong. I'm not going to just sugarcoat it and say it's easy peasy. This isn't like just moving funds into a retirement account, but it is something that I like, especially if you're someone who is already interested in buying a short-term rental. You're thinking this is something you want to do in the next 6 months, 3 months. Is now a good time if you're maybe have a bunch of income that comes through this year? Maybe that's something seriously to consider, but that would be mine. What's yours?
Yeah, mine, I'm going to say the vehicle deduction. And before I get into the vehicle deduction, let me just comment a little bit on the short-term rentals, right? So first things first, if you're going to be using a short-term rental around year end, you absolutely do want to make sure that you do have guest stays like Ryan mentioned, because without the guest stays, you can't use the short-term rental loophole. There was a tax court case, and we discussed it here on the show before, where the tax court determined without any period of customer use, basically, it's impossible to determine the average period of customer use. So in order to have the average period of customer use 7 days or less, you actually need to have guest stay. It's not simply enough to place the property in service. And of course, you do want to have your time log. You want to make sure that's tightened up 100 hours and more than anybody else. Or if you're going to be using another test, you have that ironed out as well. But with that aside, vehicle deductions, this is probably my favorite year-end tax strategy, assuming you need a vehicle, right? We don't want to let the tax tail wag the dog. We don't want to go run out and buy a vehicle just for the sake of the tax deduction. You have to ask yourself, do you really need the vehicle? But here's why it's my favorite strategy, right? So if you buy a vehicle, you guessed, if you're a long-time listener, you already know what I'm about to say, with a gross vehicle weight rating of 6,000 pounds or more, and you use it more than 50% for business purposes, then you can use bonus depreciation. And if you're using like the short-term rental loophole, or you're using the real estate professional status, or you have a business, something to turn the losses from depreciation non-passive, it can be quite a powerful strategy. And here's where the year-end part comes in. The greater your business use percentage, the bigger your deduction. Okay. And if you buy it around year-end, say, October, November, December, and you drive it exclusively for business, so in other words, 100% for business, it's quite possible that you're going to be able to bonus depreciate the entire amount. Now, bonus depreciation in 2024 is 60%, but 60% of 100% is a lot better than 60% of, say, 50%, right? It kind of puts that into context. So here the caveat is, okay, so use it 100% for business purposes between now and year end. All right. You have to use it at least 50% for business for the next 5 years. Okay. In order to avoid recapturing any of your deduction. But the reason why, again, I like this strategy around year end is because it's a lot easier to get 100% business usage around year end than it is throughout the year, as most people use vehicles for personal purposes here and there, which can impact your business use percentage. But that's why it's my favorite one. Again, you guys got to be reasonable with the vehicles that you're purchasing for the type of business you have. If you have exotic cars to drive to your C-class rental properties, the IRS may not like that. But all in all, things like trucks, SUVs, like Ford F-150s, things like that, those are usually going to be appropriate vehicles for real estate businesses. And that's why it's my favorite deduction. It's perfect for around year end.
Yeah, it needs to be ordinary, necessary, and reasonable for your business type.
Right.
Maybe an exotic car would be something that, some person in, I don't know, New York City, Manhattan is selling, multi-million dollar real estate and they buy an exotic car, as part of that. Maybe that makes more sense for that type of business. But for rental investors, yeah, probably not. And it's also fairly easy, right? As we talk about the short-term rental strategy as a year-end tax strategy plan, like there's a lot of work that goes into one, getting financing, two, even identifying your market, three, pulling the trigger, getting through closing. You've got all the inspections, all these things. There's so many parts of the process that could go wrong. To go out there and buy a vehicle, to me, that's pretty easy.
Yeah.
And there's no time requirement. There's no material participation that comes along with vehicles, right? We're looking at mileage use. And so that's like a business use. We got to meet that, like you were talking about. But there's no hours. It's just what are the hours or the driving miles, I guess, that we're looking at. So it seems like it's a lot easier. It's a lower dollar amount that we're talking about. And there's obviously, the 60% bonus, that's true. But with a real estate property, we've also got to strip out land, right? And then we've got, okay, how much of the actual building is bonus? So there's just more calculus that goes into that in the short-term rental strategy. And there's, I think, just a lot more difficulty in that. But certainly, if we're in 2024 here and you're listening to it now, 60% is the current tax code amount. Obviously, next year, we're looking at 40%. So this is, if you're thinking about the phase out having an impact on the timing of when you're going to acquire a property, really before the end of the year is better theoretically than say early 2025 when we'll be at 40%. Absolutely.
Yeah. So definitely want to keep those considerations in mind. We do have some other year-end tax strategies to talk about. Real estate professional status. This is not so much something you're going to qualify around year-end, to be honest with you. If you haven't already kind of put a big dent in it, it's very challenging, if not impossible, to qualify at this point. But you want to make sure you have your time log in order. If you have any investment properties that you did purchase, you want to make sure that they're placed in service towards the end of the year. If you do want to take advantage of 60% bonus depreciation this year. Now, the key difference here between placing a property in the service, like a long-term rental property in the service, is that you do not need to have it rented for it to be considered placed in service. It needs to be rent ready and available for rent. So if you do qualify for the real estate professional status, you could buy a long-term rental, or you already have a long-term rental that you're waiting to place in service. Placing in the service before the end of the year could be a good move to lock in that 60% bonus depreciation. So really not too much to discuss around the real estate professional status unless I miss anything, Ryan. But just wanted to say that, it could be an easier thing to place a long-term rental property in service. Or if you are materially participating in your portfolio, you're meeting that 500-hour test on your long-term
That's what I was
rentals.
going to mention.
Right. Oh, investing in a syndicate, certainly something easier to do around year end. If you could find a good investment, again, don't let the tax tail wag the dog. There's a lot of potholes or a lot of quicksand you could step into in the syndication world. So you definitely want to make sure you're doing your due diligence and not just hopping into some investment because of the tax benefits.
Yeah, I've been surprised with how many clients and just people I've talked to who aren't our clients yet who have just been surprised about this. Hey, if I meet real estate professional status, right, and I specifically meet the 500-hour material participation rule, that they could then go put more into a syndication, real estate syndication, and then we can group that in with our other rental properties. We don't really have to do any other hours, right, for material participation. Because once we've met the 500-hour rule, we don't have to compare our time to any of the GPs, the co-GPs, whatever. We've effectively gotten the amount of hours that the IRS requires in order for our portfolio of rentals to be all considered non-passive. So caveat there is, yes, reps, but specifically, you have to meet the 500-hour rule, and you're going to want to make sure that you group make a grouping election with your tax return when you file that, just to be clear. So yeah, otherwise, Tom, nothing else I think I'd mention there. Update your time log, get the property placed in service. Like you said, you don't have to have it rented, which is the distinction between a short-term rental. You actually have to have 2 stays. That is a really key distinction there between those two strategies, placed in service versus actually having 2 stays. Otherwise, yeah, I think that's great.
With the end of 2024 right around the corner, now's the perfect time to start planning what moves you're going to make to optimize your tax situation before the year ends and get a head start on 2025. Whether you're looking to use the real estate professional status, the short-term rental loophole, cost segregation studies, 1031 exchanges, or anything in between, our team is here to help you through proactive tax strategy and planning, painless tax filing, and streamlined bookkeeping services. After helping thousands of investors save millions of dollars in taxes, we want to help you. So whether you're looking to finish the year strong or get a head start on 2025, what are you waiting for? Head on over to www.therealestatecpa.com/podcast to request a free 30-minute discovery call today. We're looking forward to learning more about your situation and how we can help. Again, that's www.therealestatecpa.com/podcast to request a free 30-minute discovery call. We look forward to hearing from you, but for now, right back into today's episode. Awesome. So moving right along to cost segregation timing. Now, whether you're using the real estate professional status or using the short-term rental loophole, or perhaps you're just looking to generate passive losses, perhaps you're not using any of those, you just want passive losses for whatever reason. The good news is with cost segregation studies is you do not need to do the cost segregation study before year end. So that's just something to put out there is you don't need to rush and get it done before 12/31/2024. You can do it in 2025 as long as it's done before you file your tax return, and hopefully you do it well before that so that you can have your tax preparer file it and not be rushing to the last minute. And the property needs to be placed in service before the end of the year in 2024. So assuming you want the 60%, and that's what we're talking about here, 2024. So cost seg timing, good news is you don't need to do it before year end.
Yeah, I feel like we could call this episode like common year-end tax mistakes or something like that, or common misunderstandings or something like that. But yeah, like Tom said, you don't have to have the cost segregation study completed before year end. You just have to file it or have it complete before you file your tax return, because you just need that to be included with your tax return. And a common question I get here is, do I actually like attach the cost segregation study, like basically PDF it into it and submit it to the IRS? No. It's just that your tax preparer is going to use the study information and then apply that to your depreciation schedule. So it's not something that you like attach to your tax return or anything like that. But then the other thing too, as people are considering this, where we've got an extra expense because we're going to have to pay for this study, whether you do a software study or a, full engineering study, that, expense could be deductible potentially in this year compared to next year. So depending on, and we're going to talk about kind of prepaying expenses here in just a minute, but depending on how you want to time the expense of that and how certain you are that you're going to meet, say, real estate professional status or the short-term rental strategy, if you're like, hey, I know I'm going to use it for this, passive or non-passive, great. Then it's a little bit like, what would hold you back and what are the tax differences there and the expense. But if you're like, hey, I need to hold on to this cash, as long as possible, then hold off on doing the actual study until you really are about to file your taxes. And you do that a little bit more last minute before filing. So otherwise, yeah, I think that's great.
Awesome. So moving right along to some of the more boring strategies, but still worth mentioning. I mean, these just aren't as sexy, I don't think, at least in my mind when it comes to real estate. So tax loss harvesting, a very simple concept, right? You have assets. It's commonly going to be public securities, things that you're trading on the market, but it could be real estate too, although this would be more challenging to pull off before year end. You sell these assets that are in a loss position to lock in capital losses before the year ends. And these capital losses can be used first, up to $3,000 of capital losses can be used to offset your ordinary income. But they first offset any capital gains you have for the year. It could be from stocks, bonds, mutual funds, etc. It could be from real estate. And then if you have any remaining losses, up to $3,000 can be used to offset your ordinary income. So relatively straightforward. Again, you don't want to let the tax tail wag the dog. If you do believe this, you have a stock, for example, and you think it's going to recover in a short period of time, don't sell it, ride it out. That's not investment advice. It's just prudent to not do that, because you have to remember the wash sale rules, right? If you sell the stock at a loss, you buy it back within 30 days, then the loss doesn't exist. So you just have to be mindful of where your portfolio is at, what assets you may be willing to sell at a loss if you have any, but it's just something to keep in mind there.
Yeah. And if you've got something that You have in, say, your brokerage account, and you're like, hey, this wasn't a good investment and it's at a loss. And you're just like, I want to wipe my hands clean. And it helps a little bit on your taxes or offsetting some capital gain. Great. That's not a bad thing to do before year end. So I always think everyone, if you've got a brokerage account, and just be clear, this isn't like a retirement account thing. There's no like
Yeah.
tax loss harvesting with retirement accounts. This is like you've got a taxable brokerage account, and you're evaluating before the end of the year. Hey, is there anything that I just continue to hold at a loss? I don't want it anymore, and I would just like to move on, cut my losses, and go invest those dollars into something else that maybe is going to grow better. So absolutely, it's not extremely common. Again, it's mostly around stocks. Obviously, we're a real estate investor specialist, but it is something, and we like to talk about it before a year, and it's pretty simple.
Yep, for sure. Now, one thing I did not put in here is another common one is charitable contributions. If you do want to make those, you can make them before year end. Of course, if you itemize your deductions, you can deduct your charitable deductions dollar for dollar against your income up to, I believe it's 50% of your AGI for cash. And it varies a little bit for appreciated assets and whatnot. But if you do want to give to charity, if you're into that type of thing, that's something you'd want to do before year end as well.
Yep. And I mean, people can consider like a charitable bunching, strategy. I'll be curious to see how the tax law might change with the itemized or standard deduction changing over time if the Tax Cuts and Jobs Act, do sunset and some of those things happen. But we'll kind of see. But as people think about charitable deducting for their itemized deductions on Schedule A, that could be a strategy where you kind of bunch 2 years of charitable giving into 1 year compared to kind of spreading it out over a couple of years. Over those 2 years, you could theoretically get more deductions ultimately. Or you might be saying, hey, I'm in a year where I, for some reason, have higher income than I was expecting or that I'm going to have next year. Okay, great. Move those deductions into the current year that are going to be offsetting theoretically at a higher rate. So yeah, absolutely something for people to consider, or using something like a donor advised fund if people want to use that.
Right, absolutely.
Hey tax smart investors, Thomas Castelli here, and I want to let you know that I recently started my own YouTube channel where I'll be releasing weekly videos on tax and wealth tips for real estate investors and business owners, and of course I'll be covering many personal tax strategies as well. But that's not all. I'm also going to be sharing the tips and lessons I learned by investing as a limited partner in real estate syndicates and funds, which you'll only find available on YouTube, and I'll be diving even deeper in tax smart insiders. And lastly, in the not so distant future, I plan to cover estate planning strategies for real estate investors, and you'll only find that on YouTube. Subscribe today so you don't miss a beat by visiting youtube.com/@ThomasCastelli or by searching @ThomasCastelli on YouTube. Again, subscribe today at youtube.com/@ThomasCastelli. I'll see you over there, but for now, right back to today's episode.
Okay, so before we get into prepaying expenses, because we're going to talk a little bit about that, let's just knock out retirement accounts and HSAs, some common stuff, right? So retirement accounts, if you have a 401k, you need to make the employee contribution before the end of this year. So that means on or before 12/31/2024. If you do not make that employee contribution and the year closes, you are toast. You can't make it. The employer contribution typically comes out the next year. So if you're self-employed, that's something you'll deal with in 2025. But remember, the employee contribution has to be made before year end. As for IRAs, you have actually until 4/15 of the following year to make your IRA contribution. So you don't have to make it before year end, just something to be aware of. As for an HSA or health savings account, we're not going to dive deep into all the requirements for it. But if you have one, you have one at this point, or you're eligible for one, then you want to make sure that account is at least opened before the end of the year, because you can make those contributions before 4/15 as well of 2025. So that's kind of clear up the retirement account situation a little bit, some common things we see. Anything I missed there?
I think just to mention, it's low-hanging fruit. It's also simple. It's easy to move funds from your bank account into these retirement account contributions. There's so many ways that people can, mess these up. So please just do your research, work with a financial advisor, something like that, to make sure it makes sense. Do I do a Roth? Do I do a traditional? And just to make sure we're talking about year-end tax savings. Roth IRAs do not provide tax savings, just to be clear to everyone listening to this, depending on how new you are into this world and kind of working with Roths and non-Roths. But yeah, just make sure that you're thinking through that, what makes sense. Consider working with a financial advisor. Certainly that's something they specialize in. But yeah, just be mindful of timing and what are the limits that you can have. And obviously those can change every year. I think this year, the limits for IRA is $7,000 for 2024, and then for 401ks are $23,000. for the employee contribution. So just be mindful. You've got timing considerations of, okay, is this something I have to get done by December 31st? Is this something that I can extend to April 15th, for example, like HSAs or IRA contributions, but then also the limit of the dollar amount that we can contribute, whether that's a 401k like up to 23,000 or the IRA limits of 7,000. So you've got lots of things to consider there. Your tax rate, that's why financial advisors come into play. So just be mindful of those things as well. But low-hanging fruit, easy to make a transfer and get those deductions depending on kind of your goals and what you're looking for this year.
Yep, absolutely. So with that kind of squared away, let's dive a little bit into prepaying expenses. If you have certain expenses that you're going to make or certain purchases that you're going to make in 2025, you may consider accelerating them into 2024 if you're going to be in a high tax bracket, or maybe you just want extra tax savings this year. Common things that make sense are vehicles. We already discussed that. Computers, different types of tech, sometimes some types of subscriptions, things of that nature. Property taxes in some cases and maintenance costs sometimes make sense to start accelerating in the current year, even though you may not use them until next year, just to lock in some tax savings.
Yeah, make sure you've paid all your invoices, all those things like that, just to make sure you're not even behind on those things like that. But yeah, really common things, subscriptions, all of that. I don't need to reiterate that, but it's, again, kind of a small thing in the way I try to explain it and talk about it is, especially if you already know that you're going to pay for something, why not just accelerate it into the current year, especially if you've got the cash for it. If you don't have the cash, okay, you just can't do that. Like there's just a little bit of like a common sense thing there. But if you've got the cash, you know you're going to pay for it. And especially if you're even considering, okay, my taxes for whatever reason, income is going to be higher this year, then why not accelerate that into the current year? Just like we think about depreciation, right? Accelerating that depreciation from the future and getting it now. It's kind of a similar idea, just with kind of normal operating expenses that you know are going to come up. So very common thing. Again, not something we harp on a lot. It might be a few $1,000s depending on your business and the size of your business, but it's always something to at least consider that we like to touch on.
Yep, absolutely. Absolutely. So there's a few more things here. We're not quite finished yet. You're going to want to start with bookkeeping, right? When it comes to bookkeeping, ideally you're doing this on a proactive basis. So you already have your bookkeeping in order in an ideal world. Keeps everything nice and clean. You already know what your income and expenses are. You know how your property is performing relative to other properties. You know things aren't kind of spiraling out of control. And on top of that, it makes everything nice and smooth for tax season when you hand over your financials, your profit and loss statement, perhaps your balance sheet in some cases, to your accountants so they can file your taxes. You want to have all of that kind of ready to go before the end of the year. If you have not started on it yet, now is the perfect time, or as good as time as any, to go ahead and get that started so that everything's buttoned up by time tax season comes around. So you're not scrambling and your returns are delayed or you don't know where things are. So always better to get a head start on that sooner rather than later.
I mean, we always talk about how bookkeeping can be one of the simplest way to get extra tax deductions. And when we say extra, it really just means that you're making sure that you're capturing everything. It's easy to miss something because maybe you're just downloading something or you're looking at a statement. Really, to make sure that you're capturing everything is to have a pretty sophisticated, and pretty sophisticated could be something that's free. It doesn't need to be wild and crazy, but something where you're doing like a bank reconciliation, right? Something like QuickBooks, something like, Stessa. There's all sorts of ones out there that people use, Landlord Studios, whatever. So like there's lots of options to like help you do that and keep things organized to make sure you're capturing all the things so that we don't miss expenses that you have and making sure that you're actually capturing them. So it's really simple, really basic. And you're also just going to be able to present if you're ever doing, more sophisticated raising of capital or financing. You've got these great financial statements, or even selling a property, right? You're selling a property, you've got these great looking financial statements that you can provide to a seller. So absolutely.
Yeah, absolutely. So kind of moving right along here, I know there's a few you wanted to hit for sure. You want to dive into shifting income to your children?
Yeah. So for people who have kids, you're paying your kids, they're old enough. We've talked about that in our blogs and our podcast. Just make sure that you're paying your kids before the end of the year. If your kids are old enough, you just want to make sure that you've actually paid. And one thing that you'll want to do of January, say you're thinking 2024, January 2025, you'll want to issue them a W-2. That's kind of best practice in our opinion, but make sure that you're paying them the wages before the end of the year. They would be captured as a normal business expense as wages, but a year-end thing to do. Again, small, maybe in the grand scheme of things. But if you're already having your kids work, you probably should pay them and just make sure you're doing that before the end of the year. A couple other maybe small ones, and Tom, feel free to jump in as you think about these too. Entity structure would be something, again, probably not tax savings necessarily. It could be if you're thinking S Corps or you're thinking C Corps, but just consider, are there things I need to be thinking about, talking about with my tax advisor and or attorney to make sure I've got the right entity structure in place for next year, like starting January 1st, maybe you're making a change in your entity classification. So just make sure you're having those conversations, you're thinking through that. And then lastly, still on entity structure, we've still got this, beneficial ownership information stuff out there from the Corporate Transparency Act. We haven't talked about that a lot, but just know as we continue to get closer to the end of the year, that is something that if you've had entities that you created before 2024, anytime before, December 31st, 2023, that will be something that you're going to need to get completed on the FinCEN website and make sure that you have that updated with all the beneficiaries of those entities and make sure that you have done that. Again, not a tax savings, but something to do to make sure that you're buttoned up before the end of the year. Any comments on that?
Not too many comments on that. We're going to have a guest come on in the next few weeks to talk about the CTA, kind of refresh all of the requirements and what you have to do to file, all that good stuff, as well as kind of tie out some of the rumors or speculation about whether the CTA is legit or not within the next few weeks. So if you're not familiar with the CTA, stick around. We will be having an episode on that covering all the details. That's all I got on the CTA.
Okay. One thing too, if you're an S Corp owner, just make sure that you've got your reasonable compensation, determined with your CPA or whoever is helping you with payroll, and make sure you've got that paid by the end of the year. That's kind of a best practice to make sure that that's complete for yourself. Any comments on that one? That one's pretty simple. Just like to put that in for S Corp owners.
Yeah, it's just you're tying out all the loose ends, making sure things are done, because a lot of things, with the exception of cost segregation studies and some of the retirement account things, like if you don't do it before year end, that's it. 1/1 comes around. Look, I've had a client of a long time ago, okay, many, many years ago, that came to me on 12/31 wanting to implement some strategies or wanting to do some last minute things, but it was at 1 p.m. Eastern and a lot of places were closed and some of these moves were unable to be pulled off. So you want to get ahead of this stuff. You do not want to wait till the last minute. It's around mid-October right now when this video is going to be released, or when this podcast episode is going to be released. So you want to make sure that you're just taking action now, not waiting till the last minute. That's probably the biggest thing that I could also say in this entire episode. Don't wait till the last minute. People are out for holidays. Your accountant might be traveling. They might not be available. They might be booked up with calls. The 401k company may be closed on the last day of the year. There could be a million and one things that could be going on as we kind of approach that holiday season. So you want to get on top of this. You want to be proactive. You want to get moving on this stuff now.
Yeah, absolutely.
All right. Is there anything else we have not covered today?
Maybe a simple thing too, not huge, potentially in the form of tax savings, depending on how this goes for you, is really just getting your documentation in order. One thing I'll mention that's simple is, digitizing your receipts, invoices, tax documents that you're going to have that might come up. That's a simple one, getting everything on some sort of cloud. The second thing would be a common one we see specifically for real estate investors is getting W-9s from contractors. That is going to be something that's then going to help you with 1099s come January timeframe when those are due at the end of January. So make sure that you're starting to get those. Essentially, you've got from the W-9 the information you need to file a 1099 to report to the IRS and them the income that they should be reporting on their tax return. I know it's kind of a confusing thing, but W-9 information to help you fill out the 1099. And then the last thing would be, again, specifically real estate investors, as we think about contractors, reviewing those invoices that they've sent you, specifically anything over $2,500 for potential items that might need to be even further itemized to use the de minimis safe harbor, right? Anything under $2,500, depending on when the property is placed in service and when the improvements or whatever were done, some of those things could be deducted via the de minimis safe harbor if you get that invoice itemized with a bit more detail. So those are a couple things I throw in there too for real estate investors for kind of some year-end documentation organization.
Yeah, absolutely. You want to make sure you get those done. So many times, we get to around the time where people need to start filing those 1099s and they don't have those W-9s and you're chasing down your contractor. Your contractor ain't getting back to you, man. They're going to ghost you, right? They know this game, all right? They know that if you don't have the information, you can't issue the 1099. You can try, but you don't have their details, so it might not get to the IRS and they could underreport or not report the income, whether that's right or wrong. It doesn't matter. This the reality of what's going to happen. So we see it every year, every single year. It's like whenever I told somebody, they're like, "Yeah, I tried to contact the contractor and they just didn't get back to me." And like I hear that every single year. So definitely get on top of that. In fact, the best practice is to get the W-9 when you first start the relationship, or at least before paying them when you have the leverage to get it. Otherwise, once you pay them and they kind of go and do their own thing, they go silent on you in many cases. So definitely important to get that stuff done. I think that's about it for today, Ryan. Did we miss anything that you want to touch on?
I mean, there's so many, I'm sure, with other industries that maybe are really niche and specific. I think for our listeners who are real estate investors, these are some of the one kind of big ones. Some of these are kind of low hanging fruits, and some of these are just really common ones that we've seen with our clients. So I think this is, for this episode, a pretty decent one. Don't we have like a webinar also coming up that we have coming?
Yeah, absolutely. We're doing a one-day virtual event called the Year-End Tax Impact. We're going to be covering a number of things from year-end tax strategies. So kind of what we discussed here today. We're going to be doing a presentation. We'll have Q&A on that. We'll also be going into the post-election results and how they may impact your tax situation from real estate and other perspectives, business and individuals, to the furthest extent that we're able to do that at that point in time. We're also going to be bringing in some real estate investors to talk about the 2025 market outlook, what to expect in the housing market, what to expect, in other areas of investing, so that you can hit the ground running when the clock strikes January 1st, 2025. If you purchase VIP tickets, you'll have access to a tax strategy panel. Me and Brandon Hall are also doing a live Q&A. And then if you get VIP tickets, you'll of course get the recordings. If you are interested in joining us, the event is free. The VIP tickets are extra, but you can learn more at make sure you put the www in, www.taxsmartinvestors.com/year-end tax impact. There's no spaces, dashes, or anything like that. It's just www.taxsmartinvestors.com/year-end tax impact. And we look forward to seeing you there again this November 15th. It's a one-day virtual event, and we'll catch you there. Lastly, before we wrap up, if you are looking for a new CPA, we'd love to learn more about your situation and how we can help. You can learn more and request a free 30-minute discovery call at www.therealestatecpa.com/podcasts. And last but not least, if you are an accountant out there, you do have real estate tax experience, perhaps you're in accounting, whatever the case may be. If you are looking for a career change, you are looking to join a firm on the cutting edge with plenty of career growth and opportunity in the future, then send us your resume at onboarding@wholecpallc.com with your resume, the desired position, and why you'd want to work for our firm. We look forward to learning from you about you as well. That's it for today, and we'll catch you on next week's episode of the Tax Smart REI podcast.